Give us a sense of how bad the situation is and what has brought us to this pass.
There's an extremely high degree of uncertainty reflected in markets. You see that in all the assets people run to when they're scared, going so far up. Long-term U.S. bonds, gold, even Bitcoin. That's a sign that people are very anxious. They're anxious because there's a growing risk that this trade conflict between the United States and Japan and China will broaden and get out of control. That those risks were already there with the president's latest round of tariff increases. Now declaring China to be a manipulator raises the specter of some kind of further retaliation, raises the specter of a situation where it will be more difficult on grounds of pride for China to say yes to U.S. demands, and therefore raises the risks of a cycle of financial conflict. That is coming at a time when we're already 10 years into expansion, when the Fed has already recognized growing risks to the current expansion, and when, given how low interest rates already are, if there were to be a downturn, there's much less room for monetary policy to act than has been the case traditionally. Traditionally, there's room for, and monetary policy does, act to reduce rates by 500 basis points or more if a recession starts. We're not going to have anything like that kind of room, and that makes the situation more precarious.
Larry, you mentioned the designation by Secretary Mnuchin yesterday of China as a currency manipulator. Was there justification for it? Because the claim was basically in response to the president saying there would be increased tariffs. You saw the PBOC really weaken, essentially, the rate for the yuan.
No, I don't think there was much justification. Currency manipulation is a legitimate issue. We tend to say that a currency is being manipulated when a few conditions are met. When the country in question is running a substantial trade surplus. China used to run a substantial trade surplus. It does not any longer. When the country in question is trying to weaken its currency, when it is selling its currency into the market to push its value down. In recent months, recent weeks, China has been entering the market not to sell its currency, but to buy its currency. Really, China's been propping it up. If we simply let market forces operate, no Chinese currency intervention, no Chinese controls on the flow of capital, the currency would fall very substantially. So when you're propping up your currency and you're not running a trade surplus, you're not manipulating the currency on any definition that is understood and accepted in the financial community. That's why this seemed to me to be a problematic designation, problematic in terms of what it meant for the Treasury's credibility, problematic in that it's hard to know what the United States could really do to enforce it, except shoot itself in the foot with more tariffs, and problematic because the United States has a wide range of concerns with China where the merits are extremely clear.
Yeah.
North Korea, some of the issues involved with trade frictions, cooperating on climate change would be examples. And so why we would choose, given that we have only limited influence with China, to take on an issue like this I don't really understand.
So, Larry, that brings us to the whole conversation of FX intervention. And you were leading the Treasury the last time that there was a coordinated U.S. action with the ECB to strengthen the euro, therefore weakening the dollar. What's the possibility of some kind of FX intervention? And what did we have to see to make that happen? Or is it also just the verbal talking about it, sort of talking down the currency that may or may not work?
Let me say the intervention that I engaged in was of a very different sort. We were asked by the Europeans to respond to weakness in the euro. We did intervene, so did other countries. But all the intervention was buying euro because the euro was weak. It was not trying to sell and trash and denigrate our own currency, which we felt would be very dangerous and would risk raising risk premiums everywhere. Europeans, in fact, were upset that we didn't add credibility to the intervention by being willing to say that we wanted a weaker dollar as distinct from desiring a stronger euro. So there's really no analogy between that situation and this one. I can't imagine any previous Treasury, whether under the Presidents Bush and President Reagan or under President Clinton or President Obama, engaging in a transaction like buying the Chinese currency against the desire of the Chinese. You know, virtually all U.S. currency interventions take place cooperatively between the Fed and the Treasury. I cannot imagine, if it wishes to continue to be respected as independent, that the Federal Reserve would take part in an intervention to buy Chinese renminbi in this environment. And if the Treasury did it alone, I think it would do more to reduce confidence in the Treasury and convey the aberrant quality of this Treasury's decision-making than it would to have a meaningful impact on currency markets. So with the Fed, it's doing grave damage to our monetary credibility. Without the Fed, it's flailing around, I think, in a fairly useless way. With this administration, one learns never to say never, but I would be surprised if we saw a currency intervention in the RMB in the near term.
Larry, if the United States stays on the path that it's on now, and if China stays on the path it's on now, what's the likelihood we will be in a recession 12 months from now?
I think it's probably still less than 50-50, but it's much higher than it needs to be and much higher than it was 2 months ago. And it's playing with fire, and you can often play with fire and not have anything untoward happen. But if you do it too much, eventually you get burned.